Now, will the resignations of those hawkish presidents, Rosengren and Kaplan, change the timeline for a Fed taper? And how might all of this affect Fed policy in the next couple of months? Joining me now is Bill Lee. He's chief economist at the Milken Institute. Bill, it's great to have you. I mean, do you want to just offer a comment about this ethics issue? And if it is likely to strip the Fed chair himself of his job, how much more important would that be in terms of changing Fed policy?
Oh, that's a great question, Kelly. As an ex-Fed staffer, and I still consider myself a Fed guy, despite the fact that I've been at the IMF and Citi much longer periods. And the key thing about the Fed is that it's had a tradition of pristine behavior on the part of its personnel. Its integrity was always unquestioned. And to see these trades done by bank presidents really saddens me because it goes against the tradition within the Fed staff. So I think the rules have to be enforced, and I think that it's very important to modernize these rules of conduct. And as far as your question about impact on monetary policy, we're losing two fairly aggressive hawks from the FOMC by losing these presidents. But it's really clear that the board of directors in these regional banks will likely pick people who are going to be very similar to them. Now, Rob Kaplan had a tremendous sway, and Rosengren had a tremendous sway because of their service and their intellectual firepower. And I think coming up, we're going to see this hawkish tilt progress more because Jim Bullard and Esther George are also becoming voting members. So we're really having a convergence of hawks, whereas the centrists and doves on the board are starting to leave.
So let me highlight this. It's very interesting, and it's against the grain right now because, Bill, as you know, the current line of thought is the more vacancies, the more likely the Fed is to become dovish. There's a lot of political pressure on them, obviously, from the White House, just the Democratic Party in general. And there's a thought that even though the regional banks choose their own representatives, that somehow that political pressure is manifested in those who are more dovish. You have a completely different point of view on this, which is, the selections will remain on the hawkish side, that we've got Bullard, who just this morning was talking about the need to shrink the balance sheet next year, coming on to the Fed staff. And so I guess the only thing I wonder is the market not pricing that in? A hawkish Fed would tend to sink bond yields. And in fact, we see them rallying, the curve steepening somewhat. And so the line of thought right now is a more dovish Fed could be a reason for that.
Well, right now, the key question is a hawkish Fed will be very aggressive against inflation. And the real question to ask is, can the Fed do anything about the current high prices that we're seeing? And Chair Powell has gone on and on about this is not your grandmother's inflation. It is not the inflation we saw in the 60s where it was demand pull. It's really caused by shortages and bottlenecks. And I think that's the line that is going to be attacked by the more aggressive hawkish members who are going to be voting members, because they're going to say, even though it's supply side generated and its duration is much longer than we had anticipated, its size is much larger than we had thought. So we're going to have to do something and pull back demand to offset these high prices and try to bring down the average level of prices. That's where the markets are starting to price in a much more aggressive monetary policy. And that's why you see the entire yield curve rise in the last several days.
I guess, and this is not my argument to make, but I do, as an onlooker, wonder if the point of high prices is to cause demand destruction, which is what it does. When natural gas is where it is, the whole point is to destroy demand. So why would you need the Fed to destroy more demand on top of that? Can't the prices just do it themselves?
That's exactly what I would say. But apparently the so-called price elasticities of these certain items just aren't enough to destroy enough demand. So the argument among a lot of the hawks is you got to offset even more downward pressure, put more downward pressure on other prices to get us that average inflation rate from 4% and better now down to 2.25%. By the way, the FOMC itself, the average inflation forecast for next year is about 2.25%. The range is from 2 to 2.5. So the majority of the FOMC believes we will be seeing 2.5% to 3% inflation sometime next year.
That's true. That's not even something we're debating. And at this point, the pressures look worse. Bill, it's great to have you. Thanks for all your thoughts today.